For the past 2 years, your cash has been working harder than it has in decades, but that gravy train may be ending soon. Let's talk about 5 ideas to consider before the Fed begins cutting rates. Let's get it started. Hey everybody, welcome to the podcast. Thanks for hanging out with Matt and Steve and myself as we talk investing, finance, and retirement here on Retirement Approved. And guys, let's talk about, before the Fed cuts some rates, some things to consider. I guess the first question, Matt, is will they? Are they?
Will they? That's the big question. And we are now looking at a 99.9% chance of a Fed cut come September. And those odds can change, but it's looking like we're finally going to see Powell and the Fed cut after being harassed by the president for 6 to 8 months at this point.
Wait, what? Huh? Come on.
No way.
Well, will we see a 25 bipper or a 50 bipper? I know Bessen's calling for a 50 bipper at this point.
Yeah, if they had it their way, it'd be down at 1%. And the reason we want to talk about this today is Matt Dombrowski actually wrote an article, 5 alternatives for excess cash to start using before the Fed starts cutting rates. And we got a lot of traction on that article, a lot of calls, a lot of people saying, hey, I've been hoarding cash. What should I do with it? You know me. Should I be buying stocks, something else, annuities? What should I do?
Right.
So that's where we have the first 2 cash alternatives. The first one is Box, BOXX, and that's a more, I'll say, higher net worth play. If you have a lot of income coming in, because the issue with this bank interest is, guess what? It's all taxed at ordinary income. So if you're maxed out at, say, 40% in taxes, 40% of your 4% is going to the government. So maybe if you're lucky, you're keeping up with inflation. So Box has a way of converting all that income to long-term gains as long as you hold it for a year. So it's a neat little tricky play, but kind of a more niche situation. And then, of course, just plain old bonds. The aggregate bond index is what we threw on here. There's plenty more. You could look at PIMCO, total return, that kind of stuff. But just core bond exposure. It's been a really tough hold for the last 5 years, our traditional fixed income investors. But now is a great time to buy because the risk is to the upside on interest rates. So if interest rates were to go up, you could see the aggregate bond index take a hit. But right now we're kind of anticipating interest rates going down at least 25 bips in September. And then if we carry it through to the end of 2026, we're probably estimating another 100 basis points on top of that. And that can all vary by a handful of moves.
Yeah, we are really bullish on bonds over the next year or two here. The one thing I do want to bring up, though, is there could be some volatility there. So when we're talking about cash alternatives, our clients typically want to hear that guaranteed word. They don't want any type of negative volatility. They want to see red numbers where bonds can go down in value. Now, they're not going to be as volatile as equities, but they can go down in value. So one of the things that I'm talking to our clients about is MYGAs. So we've all been spoiled with these rates lately, locking in, 4% fully liquid. We're just not going to have that going forward, and we're going to see cuts. I think starting next month, it looks like almost a guarantee that we're going to see a cut at this point, and we're going to see them all through next year, like Matt just said. So what I'm saying to my clients is let's lock in these rates at 4+%. And you look at these multi-year guaranteed annuities, and they do just that. Whether you want a 2-year, a 3-year, 4-year, all the way up to 7, 8, 9, 10 years. So I've had a few clients that have said, hey, let's lock in almost 6% for the next 7 years. I'm completely fine with that. I mean, go back. I was laughing with a client about this. Going back 10 years, he said, I wish there was a vehicle where I could just lock in 4% for my retirement. I would be so happy with that. So we're looking at a 7-year now going, we can lock in almost 6%. It's like, well, maybe I'll think about this. Like, think about how spoiled we've been over the last couple of years here. So these rates are not going to be around. If you are sitting on a couple $100,000 of cash, which a lot of our clients are, they don't tend to listen to us when we say, hey, 6 to 12 months of expenses in a cash position. They don't tend to listen to us there. So if you're one of those clients that is, I've got $200,000, $300,000 sitting here in cash, look to lock it in something like this and get that guaranteed rate. And I've got a few clients that go, this is my vacation fund. So you can take this interest typically every year if you want to. So you throw a couple $100,000 into something like this. that's going to kick off $10,000 of interest. There's your vacation every single year. So that's something to consider as well.
Yeah, and I've sat with a few clients now explaining that these vehicles aren't going to be available more than likely in 18 months, or they're going to be available just at a 3.25% rate or something like that. And they said, okay, I'll just give you a call when my bank account goes from 4%, we're earning 4 right now. I'll let you know when it's down under 3, because that number is kind of the crossing point for me, where I'll look to implement it. I'm like, well, this is all going to be different by then. So now is the time to lock in before the Fed starts cutting rates in something like this. And we're also seeing really strong rates in fixed indexed annuities. And we're not going to get into anything product specific, because there's a million different products from a million different companies. But the one annuity Matt mentioned in his article was, it's called the Security Benefit Top Ridge. So strong company, strong product. They actually pay a 21% cash bonus right off the jump. So that's equivalent to 4 years of a 5% MYGA return. So it's very strong. And then with fixed index annuities, you participate in the market upside. So you get none of the downside, you get some of the upside, and that's going to vary company by company. You could maybe have a 6% cap like that one, because of the bonus. The cap's going to be a little bit lower. Some of the caps are in the 10% range, though. So if you want to play the market, but have none of the downside, that's a great way to do it.
And again, when we start talking about annuities, it almost feels like, in a way, you're getting kind of salesy. This is for our clients that are sitting on a ton of cash. Our pet peeve is when you have all this cash and it's not making anything, it's losing to inflation every single year. You're losing purchasing power. We want to at least keep up with inflation. So these vehicles allow us to do that in a guaranteed way. So that's all we're looking at here. Typically, we would tell you, let's get it in the market and go after more of a return. But this is peace of mind money. And I've learned to kind of just, if you want 2 years, 3 years in that safe bucket, who am I to tell you at this point that you are wrong there? If that's your peace of mind bucket and that gives you peace of mind that you're going to move through a down period, I'm completely fine holding that. But let's look at some alternatives to at least keep up with inflation. And that's exactly what these vehicles are going to do in a guaranteed way.
Yeah, and I'll point out that 3 of the 4 that we've gone over have some sort of tax benefit to it, because a lot of the issues with bank money, CDs, high interest savings, is that tax drag. So annuities, so MYGAs and FIAs are tax deferred. If you take after-tax bank money, throw it in an annuity, you're not going to get a 1099 on that interest until you take a withdrawal from that. And that's also taxed at ordinary income too. You don't get a tax benefit there. Like Box, where Box becomes long-term gains as long as you hold it for a year. And then our final number 5 alternative for excess cash is probably the thing that people want to hear the least. when you're holding hundreds of thousands in cash, you don't want to hear, hey, the market is the place to be, but it truly is. So if you have money sitting there and you're okay with some volatility, and more importantly, you have a time horizon of, I'll say, greater than 5 years, the market has proven time and time again it will provide returns. So other than 2000 to 2010, the last decade, that can happen. But this is just the S&P 500. SPY is the ticker. 1 year return, 2022 or 22, 3 year, 16, 5 year, 15. But this opens you up to massive swings and volatility.
Keywords there: time horizon.
Yeah.
10 plus years. This is certainly not something we're betting on for 1, 2, 3 years. If you're looking for just consistent, smooth returns there, I think you're much better off going with a CD or looking at a MYGA just to lock in that 4 or 5% range.
Yeah. Or more than likely, it's just going to be a combination of a couple of these. Maybe you do a MYGA for half of it and are comfortable throwing some in the market because you've got that principal protection.
Yeah. I was going to ask you, Matt, how do we know what's the right fit, right? So it's clearly not a one size fits all. Could it be a little of this, a little of that, the tax considerations, all that, right?
Yeah, and it mostly depends on the purpose of the money. If it's just sitting there because you want it to sit there, well, then an FIA might fit the bill because you can access it. They typically come with a 10% withdrawal provision, and if you don't need it, you'll probably get the most growth with the least amount of downside exposure. But you never know. A MYGA could easily outperform an FIA in a given 5-year time period. It's all dependent on the market at that point.
I feel like those are more so true cash alternatives. This number 5, this the stock market's not really a cash alternative. Is slide number 6 crypto? So again, most of our clients, this is more of their growth bucket, cash alternative number 5, where we have that time horizon. If it's truly a cash alternative, you're looking at something like a CD, a MYGA, maybe some short-term fixed income if you're okay with a little bit of volatility. But.
Right. And to be fair, this was more like a year ago. We were saying, hey, well, look at the market. It's strong growth potential. We've now had back-to-back 20% years in 2023 and 2024. We're up 10% already. So that's 50% in market growth. If you've been sitting in the bank, you probably don't want to throw it into the market and have that downside exposure. We get that.
And going back to the MYGAs too, we've staggered them a few times. So I just worked with a client that had close to $400,000 just sitting in the bank, really not doing much of anything. We did a 2-year MYGA as well as a 5-year MYGA, and we looked to stagger them. So that's something you can do too. So you could keep 100 liquid if you wanted to, and then put 150 in a 2 or 3 year MYGA, and then 150 in a 5 or 6 year MYGA. So you can stagger those as well. I think that's a great alternative than just keeping that money in the bank, really not doing a whole heck of a lot, or even if it's doing 4% right now, that's going to go away pretty quick over the next year or so here.
Yeah. The one caution, or at least thing to be aware of with a MYGA though, is let's say you did a 5% MYGA and it gets you a 20% or $25,000 in interest over that 5 years. That will all be taxable at maturity unless you roll it into another MYGA. That's called a 1035 exchange, or any annuity. You could go MYGA to FIA, variable annuity, or to another MYGA.
What's the big takeaway, Steve? Be proactive?
Absolutely. You got to start acting before these rates come down. So like Matt said earlier, it's like we can't, if you come to us in 6 months and say I was getting 4%, but now it's down to 3 or sub 3, there's not much we can do at that point, especially if you're looking at something like a MYGA. Those rates are going to come down too. So if we want to lock something in, now's the time to do it. In 6 months to a year, we could be telling you something completely different. It's like, hey, we recommend going over here, keeping it liquid, looking at this investment vehicle, maybe moving more into the market. But these MYGAs, as rates come down, they're going to get worse and worse over the next 6 months to a year.
Yeah, I don't think we even wrote one MYGA from like 2010 to 2020 because we were in a zero interest rate environment. And if the president had his way, we'll be back there sooner than later. So.
Well, all right. So it's either 4 or 5 ideas to consider, depending on which Paul brother you want to listen to, for some things to think about doing. So if you need some help, as always, click on the links below. Get yourself some time on the calendar. We've got links to get in touch with the team and get yourself a chat and a conversation in place. You can find all that below. rwpaul.com is where you can go for that. Of course, you can also go to retirementapproved.com and subscribe to the podcast on Apple, Spotify, and of course right here on YouTube. Hit that subscribe button, thumbs up, and notification bell to catch new episodes when they come out. As always, guys, thanks for breaking it down. We appreciate your time here on Retirement Approved. Catch you next time.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.